Hi folks, welcome to this next video on cash flow statements. Here we're doing a cash flow statement for Quicklaw, which is an example from your text. So let's begin. Again, the three-line title is company name, name of the statement, and again for the year ended because you're reconciling the cash balance from beginning to end. And in this case, our numbers look small, but they're in thousands of dollars. So again, we start with cash flow from operating activities, then go through to investing activity cash flow, and then financing activities. So let's have a look at what our cash flow statement looks like in each section. Again, because we're using the indirect method, we start our calculation of cash flow from operating activities using the net income, which they gave us in the question, and what we need to do is we need to convert it to the cash basis. So we can see from our question, we need to look at all of the non-cash current assets and current liabilities and see how their change in balance affected our cash flow statement. We see, first of all, our non-cash current asset. Just below cash, we have receivables, and we can see those receivables increased by $720 during the year, and we have our calculation down here. So now, how did that happen? Well, when the receivables go up, what does that mean? That means that we sold more on credit than we collected. We want to reflect what we collected, which is less than what we booked in credit sales on our income statement, so we are going to reduce our net income to convert it to the cash basis by $720. We also see that we have a decrease in merchandise inventory. So when our merchandise inventory decreases, that means we sold more inventory to our customers than we actually purchased. We want to reflect the cost of purchases because that's what's going to be paid out in cash. That cost of purchases is lower than the cost of goods sold. When our merchandise inventory decreases, we debit cost of goods sold and we credit inventory. All we're saying is we did more debiting of cost of goods sold than we did purchasing of inventory. What that means is it's the purchases, what we bought in inventory, that's going to wind up being paid for in cash. So because that number is smaller, we're going to need to add back the difference, which is $480, in order to convert our net income to the cash basis. We also have an increase in accounts payable. When our accounts payable increases, what happens? It means we racked up more liabilities by incurring more expenses than we actually paid down. We want to reflect the fact that we paid down less to settle liabilities than we racked up as expenses when we booked these increased payables. So in order to do that, we need to increase our net income by $480. We've also got accrued liabilities. These would be things like your adjusting entries at year end, wages payable, salaries payable, rent payable, those kinds of things. And those accrued liabilities decreased during the year. Why? Because we paid more of them out during the year than we actually recorded as accrued liabilities. So when we pay more of them down, that means we're paying out more than we're expensing to income when we set up those liabilities to be paid at a later date. So now we're going to reduce our net income in order to convert it to the cash basis by that difference, which is $160. And again, you can see we've calculated all those amounts for you down here. The other thing we've got, if we look at the income statement, is we know we've got depreciation expense. And as we've said before, depreciation expense is non-cash. It's included in this $1,000 we've got up here. And what we want to do is we want to add it back because it's non-cash. So we add back the 80, and that gives us a net cash inflow, in our case, not an outflow, but an inflow of $1,160. If we look at investing activities now, we can see that we have two items that affected our investing activities. The first item that they give us is the fact that we sold a long-term investment. So you can see here that the long-term investments were sold for cash at their original cost. If we look at the long-term investments, we can see that they went down by $160. If we sold long-term investments that we had booked at $160 and we sold them for that amount, that means we credited cash. So I'm just going to do a journal entry in here, debited cash when we sold it, right? So we're going to debit cash for 160 because that's the amount of money we got for that long-term investment, which is 160. So again, how I got this, I'm just going to lower this calculations thing here. How I got this was I just looked at the statement and I could see my long-term investment went down by 160, the balance. That means I must have credited the long-term investment by 160. Well, if I sold it for exactly what I had it booked at, I debit cash for 160. In other words, if I had sold it for more than what it was booked at, I'd have booked a gain down here. If I had sold it for less than what I had it booked at, I'd have booked a loss up here, right? But I didn't. It's an even Steven deal. So all I'm saying is that that 160 represents an inflow, which is as a result of an investing activity. So I'm going to increase my investing activity cash flow by 160. I've also got property, plant, and equipment that I bought during the year. So I could see here, although there were no sales of property, plant, and equipment, meaning I didn't dump any or sell any, I can see that I bought some. How do I know? Because my balance in the PP&E account went up by 320. It went from 2720 to 3040. So I know I must have used cash to buy that equipment. So my cash outflow was 320. So at net, I have an outflow here. So I have an outflow in here, which is negative of 160. Now, if I look at my financing activities, what do I know? Well, first of all, I know that in this case, cash dividends were declared and paid during the year. So this question gets a little bit interesting. Why? Because in this case, they didn't tell you how much they paid in cash dividends. They didn't give you any of that. What they told you is that you declared and paid cash dividends. You have to figure out how much you paid. So we can do this through an analysis of our retained earnings account, because we know retained earnings went from $3,040 to $3,920. Well, one way that happened is we booked income of $1,000. But if we look at the right-hand side here, we can see that retained earnings opening of $3,040 and income of $1,000 doesn't bring us to $3,920. But if we reduce the retained earnings by $120, it would get us to this balance. Why would retained earnings be reduced? Because we declared and paid a cash dividend. So we know that we paid dividends as one of our financing activities of $120. We also know that we issued shares. How we know that is if we look at the common share account in our comparative balance sheet, we see it went from $2,720 to $3,040. That must mean that we issued shares, and when we issued those shares, we credited common shares and we would have debited cash to receive the money for the shares. That debit to cash represents a cash inflow from our financing activity. So if you wanted to see the entry there, I'm just going to change this guy up. And here I'm going to, just to save some space on the page, I'm going to make my entry here, and that's what it would look like for common shares being issued. So it's this debit of 320 which gives me an inflow of 320 here. I also know that I retired bonds. How do I know? Have a look at the statement. The balance sheet says your bonds went from 2,400 to 2,240. That means that we must have retired 160,000 in bonds. So that means what? That means that my bonds payable must have gone down. Must have gone down by 160. And when I retire my bonds, I'm paying back the investors the face value, and that was 160. So it's this credit to cash, which is payment I made to retire my bonds. So when I retire or dump my bonds, bonds are a normal credit balance, so to reduce them or to retire them, I debit it, and then I credit cash to pay out my investors. So if I add these three little guys up here, I'm going to get a net cash inflow of $40. So the net cash inflow from operating, the net cash outflow from investing, and the net inflow from financing gives me a net increase in cash of $1,040. And if you check your cash balance, it went from $1,840 to $2,880. That is exactly $1,040. If I add that change to the opening cash balance, now you can see I will get my ending cash balance at the end of the year of $28.80, which is what I should have. So this concludes our little view of the cash flow statement for Quicklaw. Again, don't forget, you do have, if you're getting confused in this operating activity area, don't forget you do have your shortcut rules posted in your course. So feel free to look at them anytime, print them out as you're going through the problem, and maybe that will help you to understand a little bit better how to get cash flow from operating activities if you're feeling a little bit challenged in that area. Anyway, I hope you found this video to be of help, and oops, don't want that, and enjoy your viewing.